Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the Equity Mates community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are going to cover a lot today. We are bringing back Investor Cheat Sheet, one of our favorite segments where we look under the hood at what is in the portfolio of some of the best investors around the world.
Yep.
We are answering a question on ETF overlap, but first of all, we've got a heap of news to get to.
News and markets.
All right, well, to kick things off the back of last episode, Ren, we spoke about Rio Tinto getting into the lithium game.
Well, getting more into the
Trying
lithium game.
to. They've made an offer for Arcadium Lithium, a $9.9 billion bet, offer, whatever you want to call it.
90% premium to the share price.
Crazy.
Is what I read. Yeah, it's a big offer, a 90% premium,
Wild.
which is big, but obviously the lithium price is down, more than 80% from its 2022 highs. Macquarie Bank did a sum of its parts analysis of Arcadium and came in at around $8.5 billion value. So, it's not as big a premium to that value, but it is a massive premium to the current share price.
Yes.
So you'd be pretty happy if you're an Arcadium shareholder at the moment, I guess.
Yes. Well, let's keep moving. So it's fascinating to see what is playing out in China at the what's playing out in China and the effect that is having on markets and commodity prices around the world. We've seen the China's National Development and Reform Commission announce stimulus, which we knew was coming, but it's not to the extent that markets anticipated.
And it's a real lesson for how one policy decision ripples around the world. And this was a really clear illustration of that. So markets were expecting a certain level of stimulus, and then China came out and delivered a lower amount of stimulus than expected.
Yeah.
And so the first order effect of that was the Hang Seng stock market index in Hong Kong. It dropped 9.4%, which was the biggest drop since 2008 for that index. But it didn't stop there. The ripples continued to spread out. Commodity prices were the next affected. The Brent crude oil price fell 4%, and the iron ore price fell 3%.
Yeah.
The reason that these fell is the stimulus was lower, and so then there was an expectation of less Chinese demand than had previously been thought. The next ripple to ripple, the next
ripple
was the Aussie dollar fell 0.5% because there was anticipation of less Chinese buying
Exports.
of Australian iron ore and other Australian exports, but mainly Australian iron ore. And so then the Aussie dollar fell. But Bryce, it didn't stop there because over in Europe, the European market hit a 2-week low because European miners fell for similar reasons. But also European luxury brands fell, LVMH and the like, because of expected weaker demand from Chinese consumers because there was less stimulus than originally anticipated.
LVMH fell 6% on
Wow.
the news. Yeah.
So how's that as a little illustration about how things ripple through markets?
Yeah, it's crazy. And how, not powerful, but how interconnected it is and so much reliance on China for global organizations.
Well, yeah, I mean, we could do a very similar story when the US makes a surprise policy decision. Probably not when Australia makes a surprise policy decision, but it just shows how interconnected everything is these days.
Absolutely. Yeah. Activist short seller Hindenburg Research. We've spoken about them on the show a number of times. They've released their latest short report targeting none other than my stock of the year back in, I'm going to say 2020.
It was COVID. It was like
2021.
or something.
Yes.
Yeah.
Gaming giant Roblox.
Yes.
Now, Hindenburg claim that Roblox has inflated its numbers. I remember when we were talking about it, they said something like 25% of kids in America play the game or something along those lines. I think they have about 30 million daily active users or thereabouts.
No. You're 79 million daily active users.
Oh, wow. There you go.
And it was something stupid. It was like half of kids aged 9 to 14 play Roblox or something like that. It is actually crazy. And if you aren't familiar with Roblox, ask a kid in your life because I guarantee you they either know it or play it.
Well, Hindenburg claim that they've inflated their numbers, including daily active users, And that they've prioritized growth over child safety.
Yes. They signed up and they think that there's just it's flooded with bots and stuff like that, and they think that's how they're pumping up their daily active users. And they just were saying that there's like no safety checks on the sign up process, and then you can like message other users and stuff like that.
Well, yeah, Ren, it did amaze me that for a company that attracted so much attention, they remained unprofitable.
Yeah.
It's like, guys, what's going on?
It's a fair question to ask, like, if you have half of the kids playing this game, and that's not an exaggeration, it's like, at what point do you say we should be profitable at this scale?
Yes.
But their losses have expanded every year. 250 million, 500 million, 900 million, and now 1.2 billion in the last full year.
Jeez.
But, you know, their revenue is growing double-digit percentage. In 2021, it grew at 110%. So it more than doubled its revenue. Last year, it grew revenue 26%. So it's growing really quickly, but its losses are expanding as well. That's not why Roblox have come under Hindenburg scrutiny. But so let me give you the title of the short report, because I think one thing that Hindenburg does very well is they capture media headlines with sensationalized short report titles. And I've got a few others to talk to it, but how's this for a Roblox title? Roblox, inflated key metrics for Wall Street and a pedophile hellscape for kids. Like,
pretty intense.
They're pretty intense.
Yeah.
Now, the question is, how do you think the shares responded?
Well, usually there's a fall.
Usually there is a fall.
Yeah. So I would imagine that's what's happened.
Yeah. So you're right. It fell about 9% immediately, like when it opened after the report was released. Where do you reckon shares are now?
Up.
Yeah, up 1% from where the from just before the report being released. And this is kind of my gripe with the activist short selling community at the moment, because I think if you rewind 10 years ago, they were uncovering like real frauds that regulators weren't catching. Hindenburg, Muddy Waters, like they were doing really important work. But if you fast forward now, the activist short seller community has got like a pretty well-worn playbook, and it's become like a very short-term play. And the play is you get your short set, so you make a bet about the price falling, you write the most sensational piece you can, that you try and get it picked up in the financial media. And Hindenburg do this really well because they've got a brand in this community. They get picked up by CNBC and the like. You know, we're talking about it. There's an initial fall, and that fall generally is between sort of 8% and 30%, depending on the allegations and, the company. So, but then you will almost always, sometimes even intraday, you will see a pretty strong retracement. And like that initial fall, they will make up a lot of it. And it's just like you release a report, and then I reckon they liquidate their shorts pretty quickly a lot of the time. They just profit from that initial fall. Because it just seems to happen over and over and over again. And it's like, Adani, like that was Hindenburg's most famous recent one. Initially fell within the first few weeks, it fell sort of mid 60%. Since then, it's up 140%. It hasn't recovered to where it was before, but it's just another example of
yeah, that's a good example though, where it hasn't recovered.
Well, yeah, but it fell 60% originally, but now as people have interrogated those claims made by Hindenburg more and more and more, and they've had time to check them, the stock has more than doubled from its initial fall, and it's down 17% from pre-report. So you would think if a lot of the allegations in the reports could be truly substantiated, more investigation would lead to a further fall in the share price.
Potentially.
But that's what used to happen with these true frauds.
Yeah.
Like some of these companies would go to zero.
Yeah.
Because they had uncovered something wild.
Yeah.
Whatever. That's
their business.
That's the price discovery mechanisms of the market as it distills new information. But I wanted to close out this conversation about Hindenburg just with a couple of examples of other sensationalized headlines that they use, because they've certainly made an art of this. So how about this? Renavo Biosciences, a worthless AI shell game with a murderous magician past. They seem to have a thing for magicians, because what about this one? Miracle cures and murder for hire. How a spoon-bending Turkish magician built a $600 million NASDAQ-listed scam based on a lifetime of lies. Or
Not
this,
bad.
or this one. Singularity Future Technology. This NASDAQ-listed company's CEO is a fugitive on the run for allegedly operating a massive Ponzi scheme. So
I mean, they're good at their job.
Credit where credit's due. They certainly get you clicking.
That's right. Well, yes. I guess what we never do is follow up on, has Roblox actually inflated its numbers? Probably worth actually.
Well, that's the
That's their,
investigation.
and see what happens. Well, to close out, for the first time in decades, Ren, America has seen a drop in obesity rates.
Yes, yeah.
According to America's CDC, in 2020, the obesity rate in adults was 41.9%. Their latest data suggests that the number is now 40.3%. No prizes for guessing the main driver here, though. Ozempic.
Ozempic
Yes.
and its GLP-1 drug peers. Wild that the obesity rate in adults is still over 40%.
Yes.
But yeah, pretty amazing. Another amazing story about Ozempic. So look, that covers the news. We covered a lot, but there's still so much we don't have a chance to talk about. And that is where the Equity Mates Daily news email comes in. If you want a short, sharp summary of all the interesting stories moving markets, make sure you subscribe. The link is in the show notes or the YouTube description, and check it out. You can unsubscribe if you hate it, but we don't think you will.
No, we don't. And just to close out on that, you think 40% is crazy? Australia's is 66%.
No, Australia's obesity rate is not 66%.
For adults.
No, Australia's overweight rate might be 66%, but I
Same
guarantee you, no, it's not the same
It
thing.
says portion of adults overweight or obesity has remained at 66%.
So they have like normal weight, overweight, and then obese. So that's not the apples to apples. I guarantee you we're not worse than America. I guarantee you. So according to the NIH, the National Institute of Health, nearly 3 in 4 adults 20 or older are either overweight or obese.
Wow.
So we're almost at 75%.
in America.
In America.
Yeah. Anyway,
Wild.
wild.
Big market opportunity for Novo Nordisk and Eli Lilly.
Yeah, huge.
Let's ask the community.
Hey, Equity
Hi, I
Mate.
just had a question.
Hey, Bryce, I've got a question.
As always, we love hearing from the Equity Mates community. If you would like to submit a question for us to answer on the show, just like Jane has today, head to equitymates.com/contact or use the link in the show notes to leave a voice message. But let's listen to today's coming in from Jane.
Hey mates, all of your pimps get upset when a portfolio has overlapping ETFs. Can you please explain why? Considering the fees are a percentage and most admin is automated, apart from the extra brokerage, I don't see the big deal. Cheers.
Nice, Jane.
Love that, Jane. Not sure I love our experts being called pimps. I don't know if they're going to love that either.
Oh, well, we do call it Pimp My Portfolio.
Yeah, I know.
Anyway, if you've just joined the show and wondering what Jane has said, we do have a segment called Pimp My Portfolio where we get experts to review the portfolio of community members. Thank you for the question, Jane. Yes, overlap is something that I think a lot of investors in their early days get freaked out about.
Not in their very early days, because the first thing you do as an early investor is you buy a lot of stuff because you think that's what you got to do. And then at some point you realize, you hear about overlap and you're like, oh, maybe I bought too much.
Yeah, true.
Stuff.
From the investments made in early days.
Yeah.
Yes.
So just what is overlap? Let's start there.
So overlap is essentially where you hold a number of ETFs where the underlying positions of those ETFs can be the same or very similar.
Yeah. And so the classic example of that is you might own a American S&P 500 ETF, a global stock ETF, and a technology-focused ETF. And if you look under the hood of all 3 ETFs, you feel like they're all different. They all have different names and they focus on different things. But the top 7 positions in all of those ETFs will be exactly the same.
Yeah.
The big 7 American tech companies.
Yes.
And so in that sense, they all overlap in their holdings, even though they might purport to invest in different things.
Yes.
Yeah.
So to answer the question for Jane, what is bad about ETF overlaps, or why worry about it? Why do our experts talk about it? I think, as she rightly noted, brokerage is something to consider. If you're paying multiple sets of brokerage to effectively own the same things, you don't want to be doing that. But there are more reasons to it.
Before we make our case, I think like the analysis that Jane has made is completely right, though, in the sense that you aren't paying extra management fees.
No.
And, these days, a lot of administration is automated by the platforms, or you can plug into something like ShareSite. And so, like, those two particular aspects that Jane has pointed out, she's right. You could own 1,000 ETFs or one ETF, and the management fee is still a percentage of the assets held in each ETF. So, like, in that sense, you're right, Jane. It's just that there are other considerations.
Two major considerations. I think, firstly, if you think that you're diversified by buying more ETFs, but at the end of the day, the underlying exposure is concentrated into the top 7 tech stocks, for example, you're not actually that diversified. So your level of exposure is somewhat reduced. Second is, it's a bit of a redundant way to invest, in my opinion. Like, if you're looking for global exposure, just choose the best global exposure ETF. Don't worry about then having one that's technology, one that's US. I think at the end of the day, choose the one that has the best fees and that is most aligned with your goals, and just go with the one.
Yep.
Because, you could be putting money into effectively something that 20% of the ETF is not delivering you the returns that you need.
Yeah, look, I think you've covered it. I think, if the overlap is really two ETFs that are doing the same thing, like if you do VAS and A200 to invest in Aussie stocks, I would say it's just pointless. Like, just choose one. Those are both great ETFs, but just choose one for simplicity, for less administration, and also, in that instance, A200 does have a lower management fee than VAS. So all other things being equal, just choose the one with a lower management fee. I would also say when they overlap, but they purport to do different things, like, for example, the US ETF or the global ETF, overlap is fine as long as you're aware of it and you want it. So, like, in that instance, it's fine if you say, look, I want some US exposure and then some broader global exposure. And over time, the overlap might change, but I want that exposure. Over time, we might see Chinese or European stocks rise up the ranks of the global ETF. And so right now there's overlap, but it may not always be that way. That's fine. Like, just go in eyes wide open, understand that you're perhaps not as diversified as you think you are when it's right now the same 7 stocks driving both ETFs. But the biggest problem with overlap is like an unaware overlap, when you don't know what's actually in your portfolios and you think you're more diversified than you are. As long as you can justify it, if you did come on Pimp My Portfolio and you explain this is why I've got that overlap, no one's going to blink an eye at that. It's just when you're collecting different ETFs for the sake of it, when it's like, okay, well, you can simplify this.
Yeah. Final point, simplify. I think the admin on it as well. Like, if it is true overlap and it comes to tax time or whatever it is, having one simple ETF is going to be a whole lot easier.
Yeah.
Nice. Well, thank you for the question, Jane. As I said, leave us a voice note from the link below. We'd love to get you on the show. We love hearing from the Equity Mates community.
A cheat sheet is a quick reference guide or concise summary of important information. Usually designed to help someone quickly recall key points, formulas.
So, Ren, it's time for Cheat Sheet. In this segment, we look under the hood at some of the world's leading investors to see what is in their portfolios. And today, we're looking at an investor that we have been following since the early days, and that is Seth Klarman, the founder of Borpist Group, or however it's pronounced, a multi-billion-dollar fund, billionaire himself, and one of the early books that you particularly read, and
But I would say the best investing book I've read, outside of the 2 we wrote.
Nice.
So the book is called Margin of Safety. It's difficult to buy. I don't think they print it anymore, so sometimes you see them on Amazon for like 4 figures. We would certainly not encourage you to do this, but so you can avoid doing this, often there are PDFs floating around online. But just so you can avoid those PDFs, we're telling you that. But Seth Klarman, he is known as the Oracle of Boston in investing circles, as an homage to Warren Buffett's Oracle of Omaha. He would probably be one of the I don't know, the successors to Buffett's mantle as like best investor living once Buffett passes away. He started his fund in 1982, started it with $27 million. He now manages more than $30 billion. Since 1982, his annual compound rate of return is around that 20% average. So around Buffett levels. Obviously, he hasn't done it for nearly as long as Buffett. He is a very impressive investor. And luckily for us, with 13F filings, Seth Klarman, like so many of his big investor peers, have to unveil what they own every quarter, 90 days after the end of every quarter, so we can see it.
Love it. Well, let's get stuck in. And I think the headline here, Ren, is that it's a portfolio of companies that are very new to me, at least, which I like.
Okay.
I like seeing these investors who are obviously high conviction, do the work on a lot of companies and take the bet on non-big tech.
Yeah. Well, I think that is the first takeaway before we say what he does own. None of his biggest holdings are the big tech.
No.
He does have Alphabet in there, but as a smaller holding.
Yeah.
So I think that's the first really notable thing. But why don't you, before we actually dive into the companies, why don't you just read out the top 5 and let's think about how many we are familiar with.
Top 5 holdings: Liberty Global, Wills Towers Watson, CRH, Fidelity National Information Services, and Clarivate.
Exactly. Yeah.
And to close out, newest holdings, VeriSign, Humana, Solventum, Willscott Holdings, and Capri Holdings. 5 more companies that I personally haven't heard of.
So I've heard of a few of them. Capri has been in the news a fair bit because it's kind of like America's. It's a merger of a number of American fashion houses, and it's kind of trying to be the American version of LVMH or Kering.
Yep. Okay.
Yeah. Humana is an insurance company, but I think the point stands that a lot of these companies are unknown, or at least unknown to lay people. I think the second thing is some of these companies have been mainstays in his 13F for a long time.
Yeah.
Liberty Global, for example, the only reason I'm familiar with that is because it regularly, I reckon almost since we started Equity Mates, it has been sat at the top of his portfolio.
Yes.
Just
Well, it's
quarter after quarter after quarter.
Yeah, he's owned it since 2018 and it makes up 22% of his portfolio. Just for those at home, it's a telecommunications company that does things like broadband, cable TV, telephone and wireless globally.
Yeah.
Their second largest position at 12% is Wills Towers Watson. They're an advisory, broking and solutions company for helping businesses manage their risk. A 12% position. What I've noticed through doing this segment is a lot of these experts, the top 2 or 3%, like we did last time we did Caledonia, their top positions are concentrated. Massive 20, 30%.
Even when we did Ackman in this segment, it was the same.
Yeah, and so it's like they just have these portfolios that it's just high conviction on 2 or 3 stocks, hold them for as long as they can.
There's probably also an argument that they just let their winners run as well. Like Liberty Global being 22% of the portfolio, a lot of people would trim once it got into like the mid-teens percentage of the portfolio, but obviously they've let it run.
CRH is a buildings materials company. It takes up 9% of his portfolio. They are, as I said, leading globally in building materials, providing products for construction industry, cement, aggregates, concrete, you name it, they're in it.
You probably could have just stopped at building materials.
Building materials, if you don't know, bricks, residential, commercial. They're in it. He's held that since 2023, but is increasing his holdings, so he must like that. Fidelity National Information Services he's owned for a couple of years now. He is reducing that holding. It's about 7% of the portfolio, and they provide tech solutions for the banks and financial services around the world. And then his 5th largest positions is, this is an interesting one. It's called Clarivate, and it's an analytics company in the bibliometrics and scientometrics space, which is essentially evaluating scientific literature.
Nice.
Yeah,
Okay.
very interesting company. 6% of his portfolio. He's owned it since 2023 and is increasing his holdings in that company as well.
Yeah, so it is interesting. There's a few positions that are pretty big that are relatively new. CRH and Clarivate since 2023. Fidelity National Information Services since 2022. So I think the second takeaway that I had when it came to building a portfolio, you mentioned there that your first takeaway was there are large, chunky positions at the top of the portfolio.
Yeah.
The second thing that we see repeated amongst a lot of these investors is the new positions they take, they often start really small and they build over time. And I think that's a lesson for us that we don't have to go all in straight away. So, for example, VeriSign, a new holding in this quarter, the most recent 13F, is 0.5% of the portfolio. So he's obviously taken a tiny position just to start, has some conviction, and will build it and build the position over time. So I think that's another one that we can all learn from. Capri Holdings, similar. It's 0.9% of the portfolio.
In terms of split across sector, interesting to note, communications is big. The second largest sector allocation is healthcare, and then financials is the third largest. Yeah, big emission on big tech, but I love to see that. I really like it.
Yeah, now if we close this segment out by talking about how this reflects his investment philosophy, for those that have read Margin of Safety or those that will read Margin of Safety, you'll see that his investment philosophy is like a modern twist on value investing. Well, it's really just value investing. And you can sort of see that that's reflected in the portfolio holdings. It's like there's no like high price to earnings ratio, fast growing momentum stocks in there. He doesn't really have software or big tech. He's not exposed to AI. He's looking for assets that are undervalued, that have a margin of safety, and that he can buy for less than their worth. And then he profits in theory as they return to true value.
Yes.
So that's his philosophy. It's worked for him. It's a philosophy that's probably a little bit more out of vogue with a lot of modern investors, but you can't really argue with his results.
You can't, no. He's worth over $1 billion. So Seth, if you're listening, we have reached out a couple of times for you to come on the show. The offer still stands.
How's this for a successful family? So Seth's brother, Michael Klarman, a professor of law at Harvard, and very famous in legal circles. And if you go to Harvard, the law school, Michael Klarman is one of the big professors there, and he's big name there. You go to the Harvard Business School, and it's the Klarman School of Business because Seth's donated a building and this and that. So
good on him.
The Klarman family have certainly done well.
Love that.
Maybe we'll get their parents on the show and ask them what they did.
Yeah, true. What is the secret to success? Well, that brings us to the end of today's show. If you would like to submit a portfolio for us to have a look at, please send it through to equitymates.com. Similarly, if you would like to ask a question, link in the show notes for you to be able to do that. But as always, thank you so much for listening. We really appreciate the support. If you could leave us a rating and a review on your podcast app, that would be awesome. But Ren, always great to chat. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.